If you were watching the bond ticker in late spring, the numbers would have felt like an aftershock. $36 billion in long-term U.S. Treasuries offloaded in a single month. The sellers were not hedge fund hotshots chasing fast gains. They were pillars of global finance. Canada's mighty pension plans, discreet Hong Kong family offices, the Monetary Authority of Singapore, and the vast vaults of Beijing. Their coordinated retreat signaled unease running through global markets. Behind it all loomed a storm brewing out of Washington. President Trump had ramped up the trade wars, the Fed held off on cutting interest rates, and U.S. sanctions started turning the dollar into a geopolitical weapon. For many, the risks had grown too large to ignore. And when the world's most cautious investors start walking away, it sends a message. Could this be the first real crack in the dollar's global stronghold? Let's break it down and find out what's really unfolding. The $36 billion exit, sellers and motives. Late May headlines finally caught up with whispers from the trading floors. The Treasury Department's, or TIC, release revealed that in April, more than $36 billion in long-term U.S. bonds left the books of foreign investors. Weeks earlier, institutional desks in London had noticed two European megabanks racing to unwind 10-year Treasury futures at triple their normal pace and swapping the exposure for euro-denominated paper. Client notes labeled asset-liability rebalancing hinted at something deeper than routine portfolio tweaks. The hard data confirmed it. Portfolios in Canada, Hong Kong, Singapore, China, India, Norway, and several European hubs shed a targeted slice of longer-dated coupons. The sales looked small beside a federal debt mountain topping $34 trillion, yet their timing spoke volumes. Instead of trimming short, liquid maturities, investors let go of bonds maturing in 15 years or more, signaling doubts about Treasury safety over the horizon. Trade fights escalated by President Trump, a Federal Reserve reluctant to cut rates, and the growing bite of Washington's sanctions had combined to question the dollar's role as a neutral reserve. Long-term treasuries, once viewed as the ultimate insurance policy, started to feel like assets carrying political risk. Canada edges away from U.S. Treasury dominance. Nowhere was the message clearer than in Ottawa. A remark from President Trump referring to Canada as a 51st state angered voters and policymakers alike, turning financial independence into a rallying point. By late March, advisory letters from the Canada Pension Plan Investment Board, Quebec's Public Fund, and several provincial teacher retirement systems pledged to trim U.S. bond exposure by 10% over 3 years. Publicly, commercial banks denied overt political pressure, yet internal emails framed the decision as economic diplomacy insurance. When the finance minister declared on the Commons floor that the nation's financial muscles operated free of neighborly influence, markets understood a buffer was being built. Dealers followed suit, rotating cash toward domestic and European sovereigns, using cross-currency basis swaps to control cost. The move shrank the liquidity Canada once enjoyed in Treasury auctions, but policymakers judged the sacrifice acceptable. As Ottawa recalibrated, a parallel calculation played out across the Pacific. Hong Kong's elite money managers watched Washington raise tariffs on Chinese microelectronics, batteries, and critical minerals to 54%, wiping out the so-called small package exemption that had padded exporter margins. The tariff wave coincided with a broader sanctions toolkit that threatened any institution deemed too close to mainland interests. In Kowloon's financial circles, the phrase "dollar trap" gained traction, describing the danger of holding an asset denominated in a currency wielded as a foreign policy weapon. Family offices and regional asset giants reacted by shifting treasuries into Singaporean, Swiss, and Emirati paper that carried lower visibility to U.S. regulators. Observers speculated that draining Hong Kong's treasury stash would break the Hong Kong dollar peg, yet the Monetary Authority's broad reserve stockpile kept the peg rock solid, proving that strategic diversification need not weaken currency defenses. Singapore repositions global reserves. While Canada and Hong Kong executed visible exits, Singapore moved with quiet precision. At the Monetary Authority's annual Macro Stability Forum in early June, officials updated their baseline scenario. Rather than assuming a mild disinflation in the United States, policy staff placed a U.S.-centric stagflation outcome within striking distance, requiring a reshaped reserve strategy. Discussion among attending fund managers focused on MS plans to split sovereign assets into two distinct baskets. The first would keep dollar, euro, and yen holdings to secure liquidity during global shocks. The second, labeled the ASEAN Development Pool, would finance long-cycle projects across Southeast Asia, from digital grids in Indonesia to renewable build-outs in Vietnam and expressway corridors in the Philippines. Structuring reserves this way positions Singapore as the funding hub for neighbors while reducing exposure to a single currency's politics. The plan also widens Singapore's domestic bond market, letting regional issuers tap deep pools of capital at home rather than fly to New York or Frankfurt. Portfolios had already started to reflect the shift. Traders reported steady flows out of 30-year treasuries into Indonesian rupiah notes, Vietnamese dong green bonds, and Philippine peso infrastructure issues, all hedged through Singapore's liquid non-deliverable forward market. Yield differentials alone did not explain the change. Conversations with treasurers highlighted a new priority. Liquidity remains vital, yet geopolitical insulation has climbed the checklist. If sanctions or trade measures freeze dollar channels, reserves parked in a diverse bond mix will still mobilize. The approach sacrifices a sliver of yield, but grants policymakers breathing room when politics storm the markets. Global investors watch for knock-on effects. Would European pension funds copy Canada's gradual reduction? Could China accelerate its long-debated shift toward gold and commodities? Early indicators showed measured allocations rather than panic. Still, April's coordinated sale left a footprint, proving that long-dated treasuries were no longer untouchable. The episode also reminded Washington that financial clout hinges on counterparties' trust in the currency's apolitical status, something that tensions and tariffs can erode faster than policymakers expect. Singapore's adaptation may preview the next chapter in reserve management, where yield, liquidity, and political neutrality compete for top billing. In that emerging formula, Singapore believes the latter factor now carries greater weight. India and Norway signal a strategic shift. To understand China's cautious drawdown from U.S. treasuries, a closer look at the long-term data reveals how the strategy unfolded. Back in 2008, when the global financial crisis shook markets, Beijing leaned into the dollar's stability, building its treasury stockpile to a peak of $1.3 trillion. Over the years, that figure has steadily decreased, landing at $767 billion. But this wasn't an impulsive sell-off. China applied a methodical rematuring approach, trimming long-term bonds while picking up medium-duration U.S. agency securities and building positions in gold and euro-denominated assets. Alongside that, swap agreements with multilateral banks were designed to develop China's offshore yuan bond market, creating a cushion that slowly loosened the country's dependence on dollar liquidity. Capital controls managed the pace, ensuring that exposure to dollar-based volatility declined without triggering panic. India's recent $4 billion treasury sale may seem modest by comparison, but the timing holds weight. As the Modi administration prepares a major infrastructure-driven budget, it's tapping into domestic markets instead of drawing from reserves to stabilize the rupee. The decision reflects a deeper pivot in economic strategy, one that prioritizes internal development over dollar stockpiling. At the same time, India's rising influence within the global south, especially during its G20 leadership, has elevated its position in global finance. Now, Delhi isn't just managing portfolios, it's asserting a viewpoint that questions the dominance of the dollar system. Norway's move, while smaller, carries symbolic power. Its sovereign wealth fund sold off over $2 billion in U.S. treasuries in what officials labeled a standard rebalancing. But behind that adjustment is a strong commitment to ESG principles. The fund, built from oil and gas profits, now pursues climate-focused investments. While the shift doesn't reduce dollar exposure entirely, it sidelines U.S. government debt in favor of EU sustainable bonds. Given Washington's continued support for fossil fuel industries, Oslo's stance is seen less as a monetary decision and more as a statement on energy transition policy. Hedge funds react to Fed's stalled response. Although offshore centers like the Cayman Islands often cloud the picture, they largely reflect the actions of U.S.-based funds operating through foreign vehicles. Two of the largest hedge funds, one in Boston and another in New York, responded to signals of a delayed rate cut from the Federal Reserve by unwinding long-term Treasury positions. These rotations weren't limited to bond portfolios. They spilled into the swap markets, pushing euro-dollar forward rates higher. That ripple effect sent a clear message to the broader market. Yields on Treasuries began to climb, edging toward the 7% mark, which not only raised borrowing costs, but also tested the durability of the U.S. financial system's yield curve assumptions. When hedge funds start realigning, the shift doesn't stay contained. It moves markets quickly, alters expectations, and compresses the space central banks have to maneuver. Europe eases out of U.S. Treasuries. Across Europe, several high surplus economies have started trimming their Treasury holdings, not dramatically, but with quiet consistency. France, Germany, the Netherlands, Luxembourg, and Switzerland have all reduced exposure in a coordinated rhythm that hints at deeper concerns. As the European Central Bank pivots toward rate cuts, diverging from the Federal Reserve's more hawkish stance, the appeal of U.S. bonds has weakened. Holding Treasuries now comes with higher hedging costs, making them less attractive to European portfolios that seek cost efficiency alongside safety. France, meanwhile, appears to be adding a layer of strategic intent. With growing trade friction with Washington and rising tariffs, reducing U.S. bond holdings helps Paris unlock cash flow for domestic obligations. German officials deny that sales are tied to geopolitical strain, but if tariffs on German exports continue under a Trump-led administration, then staying too exposed to the dollar would introduce unnecessary currency risk. Treasury desks in Berlin are weighing that calculation carefully, knowing the balance between trade exposure and bond risk can't be ignored. All these moves from Asia to Europe show that diversification isn't a theory anymore. It's a working strategy, one that responds to shifting monetary policies, new geopolitical realities, and the evolving definition of financial safety. Washington faces costlier borrowing ahead. From the U.S. perspective, the pressure is no longer theoretical. The risk of borrowing costs staying permanently high has become a central concern, driven by a noticeable drop in global demand for U.S. bonds. The federal deficit is already substantial, and interest payments are quickly closing in on defense spending as one of the top items in the national budget. A shift away from foreign financing means the Treasury will have to lean more on domestic buyers. That redirects the burden to banks and money market funds, which would absorb more Treasuries, leaving less capital available for private lending. The result is a slowdown in credit growth, which directly weakens broader economic momentum. The idea that American debt is naturally funded by the rest of the world no longer holds the weight it once did. So far, the response to the global sell-off has been manageable. The Federal Reserve still holds a sizable balance sheet, which gives it temporary cushioning. But with its ongoing $35 billion monthly tapering program still running, sustaining Treasury demand will likely require offering investors higher interest rates permanently. That cost could grow quickly. Congress has already taken notice. A bipartisan fiscal oversight committee is preparing for a hearing in fall 2025 under the title Dollar Credibility, aimed at reviewing how vulnerable the Treasury market has become to foreign outflows. The panel's early findings don't hold back. One summary noted that while geopolitical tensions may not instantly destroy the dollar's status as the top reserve currency, they do wear it down over time. Another warned that the pace of that erosion is much faster in today's era of instant capital shifts. The message is clear. Risk perception is turning into reality, and Washington is watching that cycle feed on itself. Global reserves shift as IMF flags dollar decline. The International Monetary Fund echoed the same concerns in its July update. It confirmed that the dollar's share in global reserves had dropped from 71% in 1998 to below 55% by the end of 2024. Although the euro, yen, and pound made minor gains, most of the growth came from the other category. Currencies like the Chinese renminbi, Canadian and Australian dollars, Swedish krona, and Korean won. This isn't just about yield. Central banks are rethinking their exposure to political risk in global payment systems. Selling off U.S. Treasuries is fueling that trend. As those bonds exit foreign reserves, it gives further momentum to the diversification process and transforms currency baskets in a way that's both gradual and profound. How the Fed might react if outflows continue. The next critical indicator will be the upcoming 2025 TIC report. With the Treasury issuing around $110 billion in net debt every month, it will need at least 20% of that to be taken up by foreign investors to maintain stability. If that share falls too low, the spread between the Fed's policy rate and repo market rates could widen, increasing pressure across the interbank system. That scenario would push the Federal Reserve into a tough corner. It would have three possible responses: expand its balance sheet again, purchase more long-term securities to flatten the yield curve, or push the Treasury to rely more on short-term debt. None of these choices come without cost. Each one would shake dollar liquidity pricing and ripple into global markets, likely raising volatility in stocks, emerging markets, and corporate debt. The dollar isn't collapsing, but it's losing ground. Despite these warning signs, this situation doesn't signal the collapse of the dollar's global role. The U.S. still offers unmatched liquidity, legal protection, and scale in financial markets. No other currency can match the dollar's depth. However, the era of acting without consequences may be over. The so-called exorbitant privilege of being the world's reserve currency is starting to come with more expensive terms. Borrowing will still be possible, but it won't be cheap. Countries like Canada, China, Singapore, and Norway are adjusting to what they see as rising political instability inside the U.S. Their reserve strategies are evolving accordingly, with a clear preference for less exposure to dollar-centric risk. These changes aren't abrupt, but they are intentional, and they are gaining pace. Can Washington slow the global pivot away? Looking ahead, if the U.S. wants to slow down this retreat, it will need to rethink its approach. Easing up on trade wars, reducing the overuse of sanctions, and restoring fiscal discipline at home would help restore confidence among global investors. If those corrections don't happen, the decline in the dollar's share of global reserves is expected to speed up. Every 1 percentage point increase in interest rates adds hundreds of billions in debt service to the federal budget annually. That kind of pressure reshapes the entire balance between domestic politics and foreign economic relationships. Today, the world is building quiet defenses, shifting reserves, redesigning portfolios, and limiting their exposure to U.S. policy unpredictability. These changes aren't loud, but they're steady. And while Treasury sales are making the first moves, the broader message is starting to reach Washington. These fences are quietly rising behind the curtain of Treasury sales, whispering in Washington's ear that geopolitical moves have a financial price. What are your thoughts on all this? Please share your opinions in the comments section. Thanks for tuning in, and see you in the next one.